Let's dive right into it.
Okay. So over the last 3 months, we did a summer series. And this summer series included the 3 key ideas we teach in our Top Money curriculum, Kyle. And we talked about tough money habits. How can my habits affect and impact my wealth? One of the key ideas that came from that is, hey, to understand where we are, we need to talk about this path of money. How is income coming into our lives? And when it becomes cash flow, what do we do with it? We spend, donate, save, and hold and invest, hopefully with the purpose of creating additional cash flow that continues to grow that wheel over time. In June, we brought this idea of permanent control. How is the activity of banking, the world of banking, affecting the way we finance everything in life? It affects the way we either behave like savers and borrowers and transfer money away and compound our wealth negatively, or whether we implement the proper habits to have permanent control and compound money in a way that's positive and growing. And finally, that last idea is, what do we build as the foundation for our wealth? All of you know, if you're in this call, that whole life insurance is what we propose to be at the bottom of that foundation, because it's the one asset that brings certainty and guarantee. It allows you to maximize the benefits your money deserves. If you miss any of that, I'm going to ask you, please scan these QR codes, go to our YouTube channel. Please do us a favor, give it a follow. It would definitely help us continue to put more quality education for our community. If you want to share any of these ideas with anyone in your community, please do so. We want to add more and more value to you as we continue to do these monthly webinars. Anything you would add there, Kyle?
Nope. I think those are 3 core ideas that we teach over and over and over, and those are all designed to help go from where you're currently at financially to where you want to go in the future with less time and in less risk. And so all of those are a heavy control conversation, very separate from the investing mindset, the business owner mindset. And so we did a complete deep dive on that. And now we're going to shift gears and we're going to talk about kind of setting those targets in the future. What does that target net worth need to look like? And how do we start running down that number? But there are going to be some variables that influence that. So why don't we dive right in?
Okay, so let's go back to the foundation. So the starting point always our path of money, and regardless of what your financial life looks like, again, the premise is that we do this in a sequence that allows us to keep the proper order and the proper amounts in the right categories to experience a good relationship with money. If you want to overlay your numbers, this is what it looks like, and a lot of you have done this with us already. We're going to use the example we use in our Top Money curriculum, which is a family that earns the top 10% income in the country, which is around $150,000, $175,000 a year. We're just going to use $150,000. If you haven't seen this example, let me orient you really quickly. They make $150,000, spend 92% of the money in everything, including taxes, expenses, donations, and they keep 8% of what they earn, or $12,000 a year, $1,000 a month. This is a family that's doing better than the average American, who only keeps 5% or less, by the way. And they're building a balance sheet with those $12,000. So far, $840,000 or so is the average net worth for this family. And net worth represents the net equity, assets minus liability, of everything they own and control. Liquidity being 6% or $50,000, right? And 94% of that being in investments that right now for this family typically is $1,000 a month in cash flow. This is the typical person in America at the top 10% of their wealth level, by the way. One interesting thing that I wanted to bring up here that I think is a really important realization, Kyle, is that I ask people all the time, hey, tell me where you're trying to go, right? And the goals typically will be around 2 conversations. What is my target net worth? Where do I want my wealth to go? And what do I want my passive income to look like? And this is when the conversation is important, because like I said at the beginning, we need to know a destination and make sure that the plan aligns with that destination. A lot of the times we ask these people, hey, saving $12,000 a year, how long would it take you to build $2, $3, $4, $5, $10 million, regardless of what their target is? And the realization becomes that what they do in the middle actually informs how long and how easy it will be to get to any target they set, right? Which is what we've been talking to you about, these 3 ideas this summer. Today, the conversation is going to be about how do we set these targets? How do we become more attuned with, like, hey, what do I actually want, and what does it cost to actually have the abundant life that I have? And we're going to do it on the basis of income. What is required in the future from income, Kyle? Anything else you would add here?
No, I think this is an interesting one, right, David? Because we have so many models, systems, and frameworks to help people get a lot of clarity and perspective on where they're currently at. Path of money, our Tough Money Works. All of it is designed to bring you closer to your money currently. In fact, this path of money, I've been talking to my son Riker. We just taught a class on this a month ago on his net worth using the same model that we use to coach multimillionaires.
Yeah.
And it gives you so much clarity when you can see things this clearly. It's just like looking at a roadmap, if you will. You kind of know Arizona's here. I want to go across the country. That's the general direction. You can see it really quickly. And then you got to start piecing together the other parts. And one of the interesting things about target net worth is, I think, number one, it can be all over the place. Mm-hmm. I've sat down with couples where I'm like, hey, what's your freedom number? What's the target net worth? And he'll tell me something like $15,000 a month. And then I look at, the spouse, the wife, and I said, well, what does freedom look like for you? She's like, my number's $25,000 a month. And I'm like, okay, we have a serious disconnect on where you're both heading in the future. Yeah. We need to get this addressed. So once we can get like a target net worth solidified or a freedom number, then it becomes how realistic and how far off is that? I think sometimes people throw out that arbitrary, I don't know, $15 million in net worth sounds good, David. If I could be making $10,000 a month in passive income, that's freedom. The problem is that what freedom looks like 10, 15, 20 years in the future? Yeah. There's going to be certain variables that throw off those numbers drastically, and you want to know that now, not 5 years from your destination. Yeah.
Especially when we all need to recognize that not all of us are building that net worth the same way, and that's what we're going to jump in here. So one of the things that I wanted to also connect here with our May class was this idea of what's the next move. We call this the tough money levels. You probably have seen this. There's a different conversation for someone building a net worth of $100,000 up to $1 million, up to 10 and beyond, because the different levels require different mindset, team members, activities, implementation. A lot of people get distracted and look at the ceiling and the fancy objects and realize that doesn't apply. Not all of us are buying commercial buildings. Not all of us are buying golf courses or multifamily properties at the level we are. So recognizing where we are, and number two, not forgetting that the foundation is what got us there and is continuing to protect us and keeping us there is really, really important. Yeah. People, when they get to higher levels, forget that their savings environments, their savings strategy, their liquidity is actually what allows them to mitigate risk that they experience as they apply more leverage and they climb up this curve. So 2 reminders there from the curriculum. So now let's bring something new here. And it's not new, but it's a way to start connecting the curriculum with what we're going to talk about. So when it comes time to calculate passive income, one of the things we do for our community, Kyle, is to leverage our Tough Money curriculum. And we introduce this idea of minimum and infinite freedom numbers. A minimum freedom number is likely the definition you've heard for passive income before, and it goes like this. If you want to understand how to set this target initially, our recommendation would be, hey, go and identify your current annual expenses. What is your burn rate annually as a family, as a business, depending on what analysis you're doing here? If you are not clear about that number, by the way, I would encourage you to work with the agent that invited you to this class from our team to do a saving strategy analysis. Where is your income going in terms of expenses? How much of it are you keeping? And let's get very clear about your total annual burn rate. When you have that number, obviously, if you want to know the monthly burn rate or the monthly expenses, you divide that by 12. And the moment, Kyle, that your assets can produce $1 more in income a month than your required burn rate every month, you will have your minimum freedom number coming in the form of passive income. This is when people say, I'm finally free. I get to choose what to do actively with my time. But the key here is that money must be producing this money for you. It has to be through investments, through leverage, through business. It cannot be your active work, right? So this will be a great starting point, right? We take that number, Kyle, and we say $11,501 a month is my freedom number. And we look at this balance sheet. And most people will go at this number, building it in 3 different kinds of investments, okay? We're generalizing here, so please give us some space to at least put a framework in front of you. We know there's nuance, but these 3 categories are typically the most common. People will take an approach of, hey, let's do an accumulation and distribution strategy. I'm going to take a 401k and buy stocks and bonds. I'm going to try to raise the value of that account as much as possible. And at some point, I'm going to distribute and consume the interest or the interest and the principal of that to draw income, right? Accumulation and distribution, that's what most typical financial planning looks like. Others will say, hey, I actually want to buy assets that pay me to own them, that produce cash flow. These are your real estate investors, people that buy notes, people that buy an equity position, a business that spits up a distribution. This may be a pension, this may be an annuity, right? Assets that produce cash flow at a certain level that is maintained. You're not consuming the asset, it's just cash flow. And the third option that we included here is somebody's building a business that is going to be an operating business ran in the future by someone else. We're going to use leverage, and the leverage is going to be people. So you may be doing one of these three things or a combination of these things to generate that passive income. And the first thing we want to put in front of you is that number, that 11,500, is exposed to the time value of money. That number today may be a different number in 5 years, in 10 years, in 20 years, because it's experiencing external pressure from the following forces, Kyle. It's either events, a recession, a death, the born of a child, things that we've talked in the Tough Money curriculum, or it's going to be exposed to volatility in interest rates, in markets, or is going to have exposure to some type of taxation we don't know about, or increasing taxation, or taxation that's been deferred, or inflation, which is a force that is becoming very prominent with the level of spending and money printing we have in our country. So something to consider. And last thing I'll say here, and we'll go into a couple of calculations, Kyle, and I'd love to hear any thoughts that I may miss. If you zoom out finally to the Tough Money curriculum, to the path of money, it's not just your passive income experiencing that pressure, but you have to remember we set this passive income as a function of our spending. And for all of us, our spending is impacted by those same forces in different rates. The level of inflation, someone like me and Kyle that have children that will go to a university potentially in the next 10 years, 15 years, is different than somebody in their 50s or 60s with different consumer goods, right? We're expected to, I think about this example all the time because college right now on average is $20,000 a year. By the time our kids go to college, a year cost of college is going to be $80,000, right? That level of awareness is what connects our goal and what we're doing today with the proper planning for the pressures that we're experiencing here. Anything else you would add there?
These are all variables we just have to understand. And I think people throw out these arbitrary $20,000 a month, $30,000 a month in passive income is my freedom number. But then we don't account for how do events, volatility, taxation, inflation, handle that. And we're going to jump to some calculators in a second, but I think just to understand this visually, we're in this room right now, our recording studio, David, and we got maybe 12 by 12 room in here. Mm-hmm. Now, this room 30 years from now will be the exact same size, 12 feet by 12 feet. It will not change. When you take $100,000 and you go out 20 years in the future, inflation is one of those variables that $100,000 in the future is not the same $100,000. And so that is one of those variables that will change that calculation, and understanding this sooner rather than later will just set you up for better success. It'll give you clarity and perspective on, is the current strategy and trajectory I'm on going to work, or do we need to shift gears, pull a different lever in order to get there? Yeah. And I think understanding those variables, they put more pressure on our passive income than I think people realize.
Yes.
And, we're going to go into some calculators and maybe depress a few of you for a few minutes, but the reality is we're going to give you some solutions by the end of this as well so that we understand what we can do about this. There's certain things we just can't control. You and I cannot control the fact that our country is in $40 trillion of debt now. Yeah. We can't really control that. What we can control is our habits around money, or what type of investments we're looking at. What's our wealth foundation built upon? There's certain things, who we're going to surround ourselves in to make sure that we continue to win. There's certain things we can control, and we want to give everyone the greatest advantage to do that.
Yeah. So let's pull some calculators, and let's just, again, if you knew that potentially there's a threat or a problem with your plan, when would you want to know? And I think that all of us in this call would say today. So let's talk about that, and then we'll spend the majority of this call talking about potential solutions and options we have available. So what you see in front of you is one of our Truth Concepts calculators. This one is called the Future Requirements Calculator. And it's going to help us do some math just to observe how sensitive is our future income requirement to some of these forces we've been discussing. So the setup here is exactly what we were talking about before in our example. A 40-year-old, female or male, doesn't matter, family, $150,000 in income, which means that they're very productive in our country, very strong income. They have $850,000, $140,000 of assets in their net worth, and they're paying 17% in taxes. The rest is lifestyle, and if you add 17 plus 75, you'll realize that they're saving that 8% or $12,000 a year, okay? And the question that this calculator asks to start is, when is retirement planned? We're going to be generous and say, hey, 65, which is the number that most people tell us when we ask this question, is when I plan to retire. And the second question that this is going to ask is, what is your projected level of income at retirement based on what you earn today? When we ask that question to our clients, a lot of the answers are, hey, by then I'm going to be done paying my mortgage. I'm not going to have any debt. Maybe the cars are paid off. Therefore, I don't think I'm going to need 100% of that income. Perhaps it's only 75% of that income. So we're going to take a quarter of that income requirement and remove it out of there, which means that at age 65, Kyle, this person will need $112,000 a year, a little less than $10,000 a month, to continue to maintain their lifestyle. By the way, if you're in this call and we talk about wealth and we talk about a good relationship with money and abundance in our lifestyle, I don't think any of us just want to maintain. I don't want to have the same lifestyle in the future. If I'm doing all this work, it's because hopefully I get to express more abundance, get to bless other, create opportunities for my family that perhaps I didn't have at the beginning, because I'm getting better and compounding that growth every day. But
so David, let me see if I'm tracking with you. So Diane and I are sitting with you. Yep. You're coaching us on this. And maybe let's do a typical financial planning conversation. Because I think you just hit on something that I want to make sure everyone hears. So Diane and I make $150,000 a year right now. 25 years from now, you're telling us, hey, we could probably have you living on 75% of what you're used to. You'll probably have less expenses. And so, for me personally, if that was my relationship with my wealth team, I'm already worried. I'm already worried that our plan involves me scaling back already. Like, why are we not playing forward? Why are we playing backwards? So this would already make me nervous as an individual. And this is why I couldn't follow the typical financial planning route. But this is where a lot of Americans, the majority of Americans, keep their wealth in typical financial products that are accumulation-based, that are deferred out till age 65. And I think the risk that we run by doing that is, I'm 37 right now, got 4 young kiddos. I will never get this time back at this age with those kids. Yeah. So if there was ever a time to live, maybe it's in the next 5 or 10 years, right? And so my wealth plan has got to evolve around those types of thoughts and mentalities. So my wealth team would also have to support that. So let's keep playing along. You're saying, hey, we can have you on 75% of what you're used to, which is $112,000 in the future. So whatever we need financially has got to support that $112,000. But this is now not assuming any of the variables that we were talking about previously that put pressure on us, right?
Correct. So let's start introducing those variables one by one, just to observe the effect they have on those expectations of future income. So the first one that, low-hanging fruit is inflation, right? What will the time value of money and the depreciation of our currency do to the need for future income, 10, 20, 25 years into the future, depending on where you are. But let's just say 25 years into the future. If you said, David, inflation is going to be around 2% steady for the next 25 years. At age 65, 25 years in the future, this person will not need in actual numbers $112,000, but instead $184,000, Kyle. Most people that I show this calculator and we just run a simple calculation like this are shocked to see that this number grew almost 50%.
So our target is 50% off already. So if our trajectory was to go out to, whatever state across the country, we're out here in Phoenix. If we were going to go to the East Coast, we said, you know what, we want to end up in Georgia. This would be like,
welcome to New Jersey.
Exactly. We're ending in a destination that wasn't even close to what we were projecting. It's 50% off at that point. Yeah. And it's pretty reasonable, 2%. I think more realistically, inflation, everyone kind of is a little bit leery of that, but 3% is probably much more realistic than 2, yes?
So let me show you what 3% is. Take a guess.
200 something.
$235,000.
Jeez.
Now we're talking about 100% increase or twice the amount of income that we were projecting at 40 for this planning, right? And again, we're not saying right or wrong. This is not a precision game. This is just an observation of awareness of how sensitive these models are to being wrong. And the likelihood that all of us are wrong is 100%. All of us are wrong about this. By the way, if we are really, really wrong and this number becomes 4, the amount of this is most families putting $200 a month in a 529 plan to save for college, not realizing that college is not going to be 20, but $80,000 a year in the future.
Yep.
Their behavior currently is not matching what's going to happen in terms of that cost. And it's really difficult to close that gap if we're not aware of this. So I'm going to go back to that 3%, and we're just going to say that this family eventually will need $240,000 in income to have 75% of their purchasing power they have today with their current income. Will wages increase? Yes. Will rents increase? Yes. Will there be appreciation in some of their assets? Of course. That inflation is affecting everything. But from an income perspective, this is a very important piece of awareness. We're not going to be withdrawing or taking cash flow at 112. We're going to need $240,000. Inflation is that 3%. So that's one of the observations here. The other observation I'd like to make is, hey, let's say you're taking a accumulation distribution strategy, right? Let's just think about if you were to withdraw from your assets and make sure you don't run out of money. What's the typical advice we hear in typical financial planning?
You can spend down, 4% of your nest egg, and that should allow you to go long term.
Right. So if we set a withdrawal rate of 4% and we do this calculation automatically, the calculator tells you that. What this calculator is saying is that every year from age 40 to age 65, this account needs to earn 7.2% net of fee and taxes to get this account to the $5.8 million you will need to make sure that 4% withdrawal rate is 240 grand, or that you would need $2.7 million today to make sure that money grows over time, when that's not the reality. This family, unfortunately, only has $840,000. So with a savings rate of 8%, $12,000 a year, they're going to need this interest rate. By the way, we show this interest rate to people, and they're like, oh, that's not that hard. The market is earning 10, 12%, right? Net of taxes and fees year after year, right? Year after year for 25 years straight. So this is our second point. What would volatility do to this plan? If one year we experience 40 and then we go to minus 30 and 12, depending on how those numbers and volatility are sequenced, the result can be completely different to that $240,000 of income, which is going to be pressure on that future requirement for how much we need to live the lives how we were living before. The really important realization. So volatility is going to be key here. These numbers are pretty significant. By the way, if you are a 55-year-old instead of a 40-year-old, and you have less time, now you have 10 years to retirement, and you have the same assets, the same savings rate, what is going to happen? The rate of return required for you to get to that same goal of $150,000, which is the requirement at 3% inflation in 10 years, 15.2% year after year after year after taxes and fees, Kyle. This is a number that Buffett is probably not even touching in the long-term rate of return of his portfolio, just so you know, okay? But a lot of people, again, focus on keeping a little bit of what they earn, and they try to crank as much rate of return instead of focusing on the conversation we had in July and June, which was banking and accumulating more capital so they can reduce the pressure and the need for rates of return, Kyle.
And this is one of those levers where this is why you can't recommend the same strategy to everyone you're talking to, because people are in different time points of their life. They have different incomes, they have different savings habits, they have different investment criteria. So knowing this for yourself, this is why you kind of have to be a little bit of your own fiduciary here. You can't rely on someone else to please just figure this out for me. There are certain things only we can control, and we've got to take ownership for that. That's, idea number one of our framework, which is the inconvenient truth. No one's coming to save you. And how do we know which variable, which lever to pull based off of my unique situation versus yours?
Yes. So age, events in life, how close you are to retirement, how can you treat your time value of money, inflation, rates of return and volatility. What about taxation? I'm not even going to change the numbers here in the calculator because I don't really want to continue to confuse anyone here. But We decided to put this chart, a chart of the history of marginal tax rates in the country. And in red, you see max rates for the top earners. In yellow, you see minimum rates. The takeaway here, hey, in average, the maximum rate since 1913 has been 56%. Today, federally is 37%. The minimum has been 11. For us, is now 10%. So technically, what we can conclude is that we are at a historically low point of taxation throughout the history of income taxation in the country. It's a very important thing to recognize, at least for the last 50 or 60 years, which makes me think a lot of people are deferring the tax payments and the tax calculation by using all these accumulation strategies. When it comes down to distribution, they're going to be surprised that potentially that calculation is going to be bigger than they thought. Again, because of the 40 trillion that the government is in debt currently today.
What was interesting too with this, David, is as we were studying some of Warren Buffett and Charlie Munger's models, they just paid a pretty substantial tax bill recently, and their reasoning was taxes are historically low right now. So if there was ever a time to just pay it, it might be right now. Key word there is might be.
Might be.
Right.
Yeah.
And that's the interesting thing about volatility, especially with taxation. If it happens to go up in a few years or 5 or 10 years, and that's when you're needing to retire, that could drastically impact all of these calculations for you. And, I've heard people say that, and I like this phrase, when you defer taxes, you also defer that tax calculation.
Yeah.
And that just doesn't sit well with me, especially when we have $40 trillion of debt right now.
Yeah.
I mean, what's the play there? Yeah. No one really knows.
So I think important ideas to understand at a high level, to understand that we're exposed to this. By the way, if you're just following an accumulation and distribution strategy, this is what incentivizes a lot of people in our community to start thinking about buying cash flowing assets or running operating businesses that they can then use people to leverage and continue to earn income through them. Because those businesses, that real estate, those notes may have increases in income through inflation. They'll be exposed to higher rents, appreciation. How do we deal with these variables? The ability to use a mortgage, right? All these decisions are influenced by the awareness that these forces are acting all along, affecting our ability to create income in the future. So enough of the information about how wrong we can be about the future and the fact that we have no control over it. So the question becomes, hey, what do we do about it? And that's a more important question, because then that brings us into a couple of ideas. Idea number one, Kyle, and this one is going to be the obvious one as part of our Tough Money curriculum. Hey, if there's a minimum freedom number, what if we just keep playing more cowbell and we make it an infinite freedom number? What if that $11,501, you apply a multiple, 2 times, 3 times, 5 times, 10 times, 20 times, doesn't matter. Whatever you think is appropriate. But you set yourself to obsessed to say, hey, I'm going to buy assets that produce a cash flow that's just not minimum, but is 10 times larger than my minimum. So I never have to worry about increases in taxation, inflation, because the income is going to be so large, our family and business is going to be okay. The example here is obvious, right? If you need $11,000 to live your life, Kyle, and you start earning $115,000 a month, the way you live your life changes dramatically.
Yep. That's
dramatically. So more passive income, obviously, it's a direction that we would encourage all of you to think about. But there's probably a deeper thought here, which is why we labeled this webinar Guaranteed Income, Generation of Guaranteed Income through our foundation. And in addition to creating that more passive income, perhaps there's a conversation here to become aware that for all of us in this call, building our foundation through whole life insurance, recognizing that we're adding certainty in preparation for the future is really powerful, because many of you have not recognized that that asset, that life insurance asset, is an asset that allows you to draw income on a guaranteed basis in the future that can be a percentage of the total income you will need to add more certainty and to reduce the effect of inflation, taxation, volatility, and events. So we want to do 2 things in this call. We want to teach you how you could potentially express this as a form of income in the future and the options you have available to you and how the benefits are impacting your ability to do this. And we also want to give you an idea of scale, why it's important to make life insurance a more significant and relevant asset in your life by increasing your premium, increasing your capacity to store money in this asset, Kyle. So we're going to go to this image here from our last webinar, savings environment, Kyle. So we put this together to give people perspective. How did we think about that?
It's a benefits conversation, right? And so, part of the acceleration conversation is what type of investments are you going to keep on your balance sheet, and do they support your wealth plan? Well, the same thing goes with your green hold box on your path of money. Where are you holding cash or cash equivalents, which act as the buffer? Or you could even say investments are your gas pedal and your cash position is the brake. You need both of those functions in your vehicle to get to where you want to go, but they are so polar opposite, and you want that. One is a protection thing and one is an acceleration thing. So in order to maximize benefits and guarantee more of us actually hitting our future target net worth, we want to build more certainty into our wealth plan. And the toughest asset we have found to do that is a whole life insurance contract, because there are more benefits into that place that would support us getting to our target net worth in the future than anything else we could find from a cash position. And what's astonishing about this, David, is we got around $7 trillion of American savings sitting in 3 of some of the most inefficient, least beneficial cash or cash equivalent accounts that exist. Not to say those are bad, because I use a checking account every day. I use a high yield savings account every day. But not a whole lot of my money or my wealth exists in those accounts, specifically because of this slide. There's just not a whole lot of benefit for me to leave a substantial amount of money with a commercial bank. Insurance companies are willing to offer me a slew of additional benefits, so a lot of my cash position is going to go there, and I get certain benefits that are really going to complement my wealth plan in the future.
And just keep in mind, the biggest picture here is banks do not keep money in other banks' high yield savings accounts, checking accounts, money market accounts. They're using life insurance companies. The regulators are allowing them to do this because they understand the quality of the collateral, they understand the benefits they're receiving, and yet they market to us a different strategy. Don't do what they say, do what they do. This is an important realization. So if we take these benefits, Kyle, and we come back to our idea of income, we put this chart together here to give you a visual model. And this is just a model, by the way, just options to illustrate what we mean and how we mean that you can actually use some of your policies in the future to draw income. So we're going to go really slowly here. If you have any questions, please stop us. We love the interaction here. But I'm going to set at least the example, Kyle. We're going to use that same family we've been talking about so far. So to start, we're going to talk about guaranteed income. In the future, at any point, you have the ability to draw income in multiple ways. How do we access liquidity from a policy, Kyle? We can take policy loans, which all of you are aware at this point, that we can take policy loans and use that form of access to the capital as a form of income. By the way, it's private. If you keep hearing me talk and you look at this list of benefits in Anchor, it is a private way to receive money. It is debt as a loan, so it's non-taxable, right? It is going to be liquid because it's a guarantee line of credit. It's on structure, so that means that you control how you repay if you decide to repay that in the future. And it gives you the ability to constantly grow the policy, whether you take that policy loan or not. So loans are one. Number two, could we take surrenders? Could we actually take money out of the policy and say, hey, I no longer want this portion of the coverage. I want that money back, right? That is a form of having the ability to withdraw cash from the policy and receiving income. By the way, these policies, based on their IRS code, are regulated by something called the recovery rule, meaning that when we withdraw money from the policy, we do it in a way that is tax-free up to our cost basis. Every bit of premium we've paid into these policies can be recovered in the future at a tax-free level up to 100% of the cost basis, Kyle. Most people don't know that. And we're not saying that any of you need to do this, by the way. We're making you aware of your options. If you put $1 million in a life insurance policy, any day in the future, you can request from your PUA cash values $1 million, and it will be non-taxable, Kyle. Powerful way. Third way, what if we can actually start to request dividends to come to us instead of being put in the form of premium into the policy as a way to also increase our ability to have income from this policy? That may have different tax consequences, tax at an income tax rate, et cetera, but optionality is the key here. Your policy can be an instrument used for future income, Kyle. So in this example, what we did was just take the same person and said, hey, they had $50,000 in liquidity, like we talked about. We're going to take 40 out of that 50, and we're going to start that policy with a big dump into the policy to create liquidity. That's their rainy fund day, let's say, and they're going to put that money in there to start the policy with an overfunding in the first year. Every year after that, all they're doing is taking their $12,000, 8% savings, and put it in the form of premium, using this as their savings environment. You all know that these policies have a certain minimum. In this example, the assumption is $8,000. The rest goes to the PUAs. Probably too technical to talk about here right now. But the idea is that this policy has minimum guarantees that are leveled and that are guaranteed for the rest of your life, Kyle. Over the next 25 years, this person is going to work and they're going to keep putting their savings, $12,000 a year. And that would mean that they would put $328,000 on this single policy. And you'll notice here, more premiums keep getting paid. This red line describes those premiums, these bars. The blue line describes the growth of the cash value or the equity in that contract. And this purple line is the death benefit that we have available as protection in that policy, Kyle.
Love it.
Okay, so at age 65, they may say, guys, we're going to retire. I'm not going to draw any more income. How do we use this policy to perhaps use the dividends or the growth inside the policy to continue to pay the out-of-pocket premiums so I don't have to pay them out of pocket, right? You'll notice here that the bars in red stop and no more premiums are ever paid in this policy. Not all of you are going to do this, by the way. Some of you that are buying cash flow assets will want a place to store money as much as possible year after year after year. But if you ever need this option to be available to you, is an option that all of your contracts have available to you, Kyle, right? Last couple of things, I'd love to hear your thoughts, and if there's any questions, we can stop here. But in the future, age 75 was our assumption, by the way. It doesn't have to be like this. It's just an example. This person says, guys, we would love to take 10 years of income for every single bit of premium that we ever paid into this policy. For the next 10 years, if we put $328,000 in the policy, we would like to get a check for $32,000 year after year from age 75 to 84 to recover our cost basis. And the question they will ask us, and you already see it in the blue and purple line, is what would happen to the policy? Will the policy die? Will the policy lapse? And what you need to understand is that at age 85, even though you recover all the premiums, this policy, Kyle, still has $770,000 of cash value available to you to borrow against, to continue to take withdrawals, growing, by the way, let me pull this back here, growing, and a death benefit of $997,000, almost $1 million in protection after you recover every single bit of premium that you paid into this policy, Kyle. What are your thoughts?
You know how to look at this, David. There's a couple things that go through my mind. Number one, I can guarantee myself $32,000 towards my freedom number. Like, that gives you a certain level of certainty. So if my hold category, where I save money for protection, can get me, let's call that 25% of my freedom number, if their freedom number was $112,000 a year, if I can get 25% of that done with no risk, I kind of like that option, right? Then I got to get my investments to perform the other 75% of the goal. And that's why this combination between, investment grade vehicles and savings environment vehicles need to complement each other. The other thing is, I see we got Kate on the call. Kate's a phenomenal real estate investor. So during this time that we're accumulating and saving up money, which protects us against future events, what if a great real estate investor like Kate has this deal of a decade that comes along? Yeah. She's in her hometown, the certain house goes up for sale. She knows it's a phenomenal deal. She can get access to any of that cash value at any time for whatever reason to go jump on big opportunities. And I think this is what people miss by having too much of their wealth tied up in investment grade vehicles that are not liquid and accessible, is you get a 2008 that rolls around. If you don't have enough cash, that event might put you down.
Yeah.
Now, if you survive 2008 and go into 2011 and 12, real estate prices went so low that if you had, $500,000 of cash value at that time, you could have bought a dozen properties and probably created $3 or $4 million doing that.
Yeah.
And that's kind of the number that we were looking at in that future value. It's an interesting model too that like Warren Buffett kind of goes with these principles too. You were coaching me on this, teaching me this, but 5 or 6 really good deals over a 60-year time frame is what they equate the vast majority of their wealth to. Like they were building wealth consistently, don't get me wrong, but they had access to cash when it mattered the most, and that's what took them from 40 billion to 160 billion. And the great part is we can all be doing that same thing. We just do it at the you and me level. Warren's doing it with billions. You could do this with millions. You could do this with hundreds of thousands. You could do this with $10,000. A lot of us are trying to teach our kids this stuff with $100.
Yeah.
And if you can get those lessons now, I think the odds of you hitting that freedom target in the future are just so much higher. And so when I see this, I see part of that journey is guaranteed to happen. I'll bet on that. And then the other piece is I kind of need to develop myself and make sure that I have access to cash to jump on these really good deals. If all of it's tied up, I don't really have a choice.
And I love that sorry, Kate, to bring you back in here, but it's lovely to see you, by the way. And, let's be honest, Kate's skills are getting better every single year. Somebody that is obsessed with education, with learning, so much experience in her markets, right? Like, do you have to do this? No. But what if instead of taking a withdrawal, what if the approach is, hey, do I have access to this money? And instead of taking $32,000 a year at age 75, I want to take the full check all at once, 328 Cal. Would the insurance company send me the check for 328 if I asked for it?
They absolutely would.
Would it still be tax-free because it's up to our cost basis?
Correct.
And you take $328,000 and buy a commercial building to triple the income that $32,000 would have done in withdrawals, or to have the lifetime experience that you always want to have.
Yeah.
Optionality is what matters here. We're not telling you, any of you, what to do, how to do it, when to do it. This is not a prescription. This is an awareness that the uncertainty in the future can only be mitigated by having more and more certainty. And the only bad thing about this model, Kyle, is that instead of $328,000 in cost basis, we wish that cost basis was $3 million, $3.2 million, because then you're dangerous.
Now that tends to happen with more time and education around this asset. And
exactly.
We do have a quick comment I want to address from Paul. And Paul is someone I would consider an expert in the retirement space. He says $32,000 a year at a standard 4% withdrawal, rules that most retirees are told to follow with their qualified account, is akin to having $1 million in a retirement account and paying 20% tax. So you would receive $32,000 after tax, withdrawing at a 4% on $1 million.
And I cannot, Paul, thank you for your comment, by the way. Really appreciate you saying that, by the way. There's something, one of our mentors that is the creator of these truth concepts calculators we use to educate you all talks about, which is life insurance through guarantees, through these benefits, through mitigating the exposure to taxation, inflation, and all those things, allows us to take our other assets and make them look like really big assets, behave like big assets when they may be smaller. Because if we can add what Paul just said, you need $1 million paying 20% tax just to get $30-something thousand at the 4% rule. This policy behave at a much more effective, efficient way. And after you recover the entire cost basis, you still have an asset with $1 million in protection, $700,000+ in growing,
still growing
cash values. I'm gonna peek here a bit, and I don't think that we have too much time to talk about this, but I do want to show you this. This is the table, the numbers that describe the chart there, and we were trying to be more visual, but notice this. Excuse me, and this is probably the second one. Let me just pull the other one just to be precise with you. $40,000, $12,000 for 25 years. After you finish your last distribution, this policy with $770,000 grew $24,000 the next year, Kyle, and it went right back up to grow like it was scheduled with no premiums paid out of pocket, and the entire basis already recovered, $1 million in protection. It's a really powerful vehicle. Again, the only thing that we would have a conversation about this with many of you is, okay, so tell me about scale. How would I make this more significant and relevant? And that's this last image I want to put in front of all of you, if you don't mind. The question that we all need to ask is, okay, so how much of our income do we want to be guaranteed then? You talked about if we need 112 and this provides 32, it's 25%. That's a solid number, right? If you add to that things like pensions, Social Security, other sources, and annuity, you can start to stack those income sources and make them pretty strong. If you have commercial property, right? There's multiple ways that all of you are going to go about this, but I just want to narrow down the answer to what happens if you make whole life a more significant part of your strategy. These two curves represent the same policy funded in two different ways. One way that you'll see here is in yellow, the standard way we've been talking about. This family only saved 8%. The second in blue is this family going through a tough money saving strategy and saying, hey, we no longer can be saving 8%. We need to decide that we need to double that and keep 16% of our income or $24,000. And that's what we're going to pay in premiums to grow the effect of this income. And you'll notice here, same schedule for 25 years, just the premiums a little larger. The cash values start to behave differently, obviously, because we're overfunding the policy further. What you'll notice here is that our total premiums go from 328 through 616. And at retirement, we get to use dividends to do the same thing we did with this, which is pay for out-of-pocket premiums. But yet the results are dramatically different, Kyle. Our annual withdrawals for 10 years, if we level them, now go to $60,000. And when we take all that money out, instead of having $770,000, our asset has $1.43 million in cash value. We still have access to, we can still borrow against, we can continue to withdraw. Stronger asset. So Nelson says it in the book, premium is the solution. And I think you were going to read in page 85, something that Nelson talks about in terms of premium. And I think is very appropriate we bring to you based on what we're discussing today.
Yeah, I always like this page in the back of Becoming Your Own Banker. And, Nelson Nash put this in here, and I think it's more relevant than ever. He says, if you knew at passive income time, you'd be getting back everything that you paid into a system tax-free, would you object to putting more money in it? And I think once you see this, how your behaviors affect your wealth plan. If we can just go from an 8% to a 16% savings rate, well, now we've got 50% of our freedom number pretty much achieved with no risk. Well, doesn't that allow me, David, as an investor to go take out maybe more risk with my actual investments to see if I can't get past my freedom number? It's an interesting relationship here between guaranteed asset, safety and liquidity, and how much acceleration and risk I'm willing to take. And once you see this, I feel like you can't unsee this. This is why people that own whole life insurance for 2 years, 4 years, 5 years, you get it out 10 plus years like we have. Those policies I bought 10 years ago, I wish I could add an extra zero onto the premiums and just shovel cash into there because they start to pump out growth like you can't even imagine.
Yeah.
And once you realize too, in retirement phase of life, that's not really a word I love to use for my wealth plan, but if I was going to retire it someday, I can get everything out of these policies that I paid in plus more, no risk, no taxes. What's the downside there?
Yeah.
And the bigger and better I build it now, the bigger my opportunity fund is building. And I'm always looking for deals at this point. You get around enough people who are really good at investing, and the thing that I feel like they're always lacking, they can find the deals, but they might not have the money. You bring the people who have the money to the people who have the deals, man, you can really accelerate that. And that's relationship capital. That's getting around the right communities. But isn't that also why banks are some of the wealthiest companies in the world? Where's the first places people go when they need capital? A bank.
Yeah.
They walk right in there, and people just bring deals to the banks 24/7. Well, maybe you and I should be doing a little bit more of that in our world, which is where I think we're going next month.
Yeah. One parting thought on this, and then we'll close here, and we'll give you the opportunity to ask any questions if there's any questions here in the audience. Is this? I think a lot of us recognize that the generation going through retirement right now, baby boomers, and 70 million people in that generation are very concerned with what happens to the longevity of their money. What if I run out of money in retirement because they're consuming what they build over 20, 30, 40 years in the workforce? And it's a real concern because, relying on some of the social services is not a solution for them to live the life they want. And I totally empathize with that. But it's also a function of the fact that they're exposed to these external forces and that there's a lot of uncertainty, Kyle. One of the things that is not shown in this chart, but I love to bring to a lot of people in this situation is this. This policy, in addition to having $1.3 million in cash value in equity that you can access, has $2 million in protection. And when I talk to a lot of my clients, I tell them, you are only taking 3-4% that Paul was talking about from your other investments. If you're distributing maybe a 401k or an IRA or equity in your home, right? Because you're afraid of over-consuming it. But if you knew that you can take a little more and actually consume that to create the abundance you want, right? Not just the interest, but some of the principal, because you know that that equity will be replaced with the protection that will come. The moment you pass, liquidity will be created. How much permission would you give yourself to actually live the life you want during retirement or passive income? And that's an important recognition. I think about this all the time, Kyle, personally, because my mom died when she was 43. It's like, we're doing all this planning for the future, but what if we don't get the time for it?
Yeah.
And I think what you said there, the things I'm doing with my 5-year-old, my 3-year-old right now in my 40s are things that I only can experience now. And
Yeah.
I need to make sure I live through this portion of my life without skipping it, because I'm concerned about what will happen to my money at 95 if I get there. And the way to consolidate those two things, again, more foundation, more certainty. Now, if any of our team members ever talks to you and insists, please, please don't see premium as an expense. At some point, you're going to make the transition to see premium as the solution, as the way to capitalize, is because in their head, they've seen this image before you, and they've understood over the long term the power of that premium growing your ability to have options, flexibility, and the ability to create guaranteed income. Really powerful function. So to end the conversation here, Kyle, just as a reminder, hey, a top 10% American family at age 65, in all the assumptions we use, who needs $240,000, not $112,000, like we calculated with that 3% inflation, Kyle, will be well served by growing their net worth and their passive income, maintaining strong liquidity, 20%, especially if it's stored in a place like life insurance, whole life insurance, because there'll be a protection and there'll be a way to create guaranteed income when needed. When needed. Really, really important consideration. By the way, this conversation goes a lot deeper. We can talk about cash flow bridges and things, how to deal with volatility year to year when your portfolio is down. How do we take money from the life insurance policy to avoid double dipping on those losses, right? There's a lot of depth in this conversation that we need to have one-on-one, but we're just giving you insight into your options for you to know that this tool that you started now years ago is more powerful than you likely have considered in the past. Finally, Kyle, we're going to do a little planting here of a seed. This infinite banking mastery idea that we've talked about often. We do this mastermind live in Scottsdale every year for all of our clients. We're going to give you the opportunity to go and get more details about it. This idea here of same policy, same income, just making it more significant and relevant in terms of premium intent, in terms of how you capitalize, in terms of how you use this asset, is going to yield dramatically different results, Kyle. If you make your habits stronger and you save 10, 20, 30, 50% of your income, and you do it in the right environments, the results not only will be different, they will be dramatically different from the people that are doing the average behavior of saving 5% in a bank account, getting no benefits.
Right.
So with that, any other parting thoughts there?
No, I think we had a couple of comments in the chat that I think were encouraging. Jared was just saying this only strengthens my conviction and the goal of directing 100% of my income into the policies. And, I think a lot of us are in pursuit of that. Once we see this, it's like Nelson said in page 85, like if you knew you were going to get everything out of this that you put in plus more on a tax-free basis in the future, would you object to putting more? No, the answer is definitely no, especially if you can do it without any risk. So then the game becomes basically, how do I optimize where I'm currently at? That could be behaviors around just financial management. It could be getting the revenue up in your business, becoming a better investor. Obviously, you know us, and our focus is on helping you understand this function of banking. If we can help you control permanently more dollars moving through your life that are going to move through your life anyways, and you can direct them into that system, well, that's only going to enhance everything we talked about tonight. It's kind of it's the amplifier for everything, is understanding how banking affects your wealth plan. And so the next 2 months online, we're going to be going deep into the banking conversation, getting all of you warmed up for our live Infinite Banking Mastery in-person event in Scottsdale. So we hope everyone comes out. It is a wonderful time to come out to Arizona.
Yes, it is.
It is in November, especially for you, Michael, way on the other side of the planet over there. It is going to be cold and chilly where you're at. You're going to want to come out to Scottsdale and enjoy some 70-degree weather then.
Yeah. As we close the call, one last thought for you to leave you with, and maybe it's a conversation that you want to have with your agent, with your team member, which is this. For all of you that have purchased policies on your children or your grandchildren or people that work for you or any other additional insurable interest, think about what's happening there from the conversation we had today. If you buy policies on your children or grandchildren, that coverage is not on you. And if we talk statistically, likely, hopefully, all of us pass before any of our children or grandchildren pass. But that asset will continue to be a source of guaranteed income for you while you control it. And when you pass and leave that asset to family, to a child, to a grandchild, that asset will continue to grow and will become a guaranteed source of income if your child or grandchild decides to and educates themselves properly to use it in ways that wealth and income and abundance become not just an asset, but a habitual behavior and a practice that creates, again, trees and shade that you'll never get to see. Do not dismiss how valuable what you're doing today with 1,000 or 500 or 2, whatever the premiums are on a child, on a grandchild. Do not dismiss that the other force that's compounding daily without interruption is time. And the younger they are, the younger these people that you insure are, the more time they have to make that impact more meaningful and significant in their life. So with that, I will thank you all for being with us again. We will be back in September with another piece of content around banking. We're going to bring more specific implementation ideas, how you can be using banking on your favor and continue to increase the use of this wonderful asset in your life at a more meaningful and significant level. Thank you all. Thank Kyle for being here.
Thank you, everyone. Have a wonderful